The head of finance in the United States has just raised all the warning signals by stating that a global economic disaster will unfold if the United States Congress does not urgently increase the federal government's debt limit. According to her, the first default could occur in just 14 days, and if this happens, it would be the first time in U.S. history that the government fails to meet its financial obligations. This, my friends, could trigger devastating effects: skyrocketing interest rates in the coming years, a downgrade in the U.S. public debt rating, an economic and financial crisis, a massive increase in unemployment, and a severe blow to the economy of the middle class and the most vulnerable. You can't imagine the terrible consequences if the United States doesn't pay its debt in 14 days. As you can see, we are talking about a very serious and very real threat. In this video, we will reveal everything that the government is trying to hide from you and what they don't show you on television. We will analyze these controversial statements and explain how serious this situation is, endangering the global economy. But before we begin, remember to subscribe, activate notifications, and leave your like as always. Let's start from the beginning. Janet is an economist from New York with a PhD from Yale University. She is one of the most respected economists in the country, and as an interesting fact about her background, she had a quite relevant doctoral thesis. Yellen has been an economics professor since the 90s until now and has been the vice chair of the Federal Reserve since February. She was also the first woman to become chair of the Federal Reserve, a position she held until February. Currently, Yellen is the Secretary of the Treasury of the United States under the presidency of Joe Biden, once again being the first woman in history to hold that position. As Treasury Secretary, Yellen is responsible for the fiscal policy of the United States government, including managing public debt, tax collection, overseeing banks and other financial institutions, as well as leading the country's economic policy and advising the President and Congress on economic and financial matters. As you can see, Yellen is a renowned economist, a pioneer in her field, and accustomed to holding high-level positions on the front lines. However, Yellen has been heavily criticized during her political career for advocating economic policies such as raising the minimum wage and expanding unemployment insurance, whose effects could exponentially increase government spending, as observed in other countries around the world. Many have been critical of her decisions, portraying her as a left-wing populist who claims to seek to defend and reduce economic inequalities. This is far from reality, and many argue that Yellen was not tough enough in regulating financial institutions and did not do enough to prevent financial crises in recent years. There has been much talk about the U.S. debt ceiling, and it is indeed a concerning issue. According to Yellen, if Congress does not immediately raise the federal government's debt limit, a globally impactful disaster will occur, and the first default, the first time the U.S. government fails to pay its debts, could happen within weeks. If this were to occur, it would be unprecedented in U.S. history and could have never before seen repercussions. As we mentioned before, we are looking at skyrocketing interest rates, a downgrade in the U.S. government's credit rating, and a severe blow to the economy and finances of the most vulnerable. If you thought massive layoffs were only a concern for late 2022, let me tell you that you are mistaken. We will start to see major companies laying off thousands of workers, and these workers are people like you, people who need to support their families. Without money, they won't be able to pay their debts, and if they don't pay their debts, it will be the beginning of the end for the economic power of the United States. As you can see, we are talking about a real threat. Interest rates continue to rise, leading to a credit crunch for the government, businesses, and consumers. In fact, a report from the Bureau of Economic Analysis states that the unemployment rate could reach 12%, nearly 4 times the current rate in the United States. All of this depends on what happens on June 1st, the date when the United States has an obligation to pay its debts. Another consequence of this situation would be the inevitable decline in the value of the dollar, triggering a wave of dollar selling and a decrease in demand for Treasury bonds. This would have a tremendous effect on all levels. For example, in commodity markets such as oil and other goods, where people and countries trade in dollars. Additionally, a decline in the dollar directly affects the United States' import capacity, which would drag down all Latin American countries that heavily rely on the dollar. The third catastrophic consequence of the United States not paying its debts is the impact on financial markets, leading to a drop in stock prices and increased volatility. Lastly, but not least, is the global systemic risk. A U.S. default or failure to pay its debt on time could have cascading consequences throughout the global financial system, as U.S. Treasury bonds are considered one of the safest assets in the world and serve as collateral in many financial agreements. In this negotiation, which depends 100% on Congress, things are tough. Republicans are proposing a deal where they are willing to raise the debt limit but want significant cuts in government spending in return. However, Democrats and President Joe Biden do not agree with this deal. Let's change the topic and talk a bit about Adobe, a software company you may already be familiar with. When you hear the name Adobe, you probably think of their famous video editing software or their PDF file reader. But did you know that Adobe has more than 50 products in the market? Most of them are leaders in their respective sectors. However, recently, Adobe has been losing value. In fact, the company's shares have dropped by 7.2% in the last month. We need to prepare because things could get ugly. The US government is on the brink of bankruptcy. This seems to be a ticking time bomb. We suggest you make important decisions and start diversifying your investments. Don't invest all your money in the United States because if the country collapses, you could lose everything. This also applies to banks. Since the beginning of 2023, we have seen a series of bank failures, and people have lost all their deposited money without the government being able to protect them. We will start seeing this more often, so get used to it. Bank failures, customers losing their deposited money, and the government defaulting on its debts. One area that could be significantly affected is the job market. A default, or even the mere threat of default, could trigger a wave of economic uncertainty, causing businesses to become hesitant about expanding their operations or making new hires. This could lead to a surge in unemployment rates, making it increasingly challenging for individuals to find stable employment and support their families. Moreover, the impact on the middle class and vulnerable populations cannot be underestimated. Government spending cuts and a struggling economy could result in reduced social welfare programs, healthcare support, and educational opportunities. This would place an even greater burden on those who are already struggling to make ends meet, potentially exacerbating income inequality and widening the wealth gap. Additionally, small businesses, which are the backbone of many communities, could bear the brunt of the economic fallout. A decrease in consumer spending, limited access to credit, and reduced government support could lead to a significant number of small businesses shutting their doors permanently. This would not only result in job losses but also create a void in local economies, affecting the overall well-being and vitality of communities. Furthermore, the repercussions could extend to international trade and global relations. The United States' role as a global economic powerhouse means that a default would have far-reaching consequences for other nations. Foreign investors may lose confidence in the U.S. economy, leading to a decline in foreign investment and potentially destabilizing international markets. This, in turn, could trigger a ripple effect impacting economies worldwide and hindering global economic recovery efforts. In such uncertain times, it is essential for individuals to prioritize financial preparedness and resilience. Building an emergency fund, reducing debt, and diversifying investments can help mitigate the potential impact of a financial crisis. Staying informed about the evolving situation, understanding personal financial goals, and seeking professional advice can empower individuals to make well-informed decisions amidst economic uncertainty. As the interconnectedness of economies deepens, the consequences of a U.S. default or financial instability can extend far beyond national borders. Investors around the world may experience heightened market volatility, declining asset values, and decreased confidence in the overall stability of the global financial system. The reality is that things are going to get even tougher than they are. If you thought 2023 was going to be a good year for the working class and the poor, unfortunately, it doesn't seem to be the case. In fact, we are in a critical moment that you must take seriously. But if you want to stay informed about news on the global economy that you don't hear on television, subscribe to this channel, activate notifications, and like this video. We'll see you in the next video.